the federal debt was 30% of GDP. Today it's 130%. Really in banana republic territory, or what used to be considered banana republic territory. And because of that, you just can't raise rates that high. You can't raise it higher than the rate at which the dollar is being depreciated. The Fed is trapped, and they will have to start reversing that tightening policy much more quickly and much earlier than the markets are now really considering.
This week's special is 1 ounce silver Britannias for only $4.50 over spot. Here at Liberty and Finance, we are licensed brokers with Miles Franklin Precious Metal Investments. We are standing by the inventory, taking orders into the wee hours of the night and on weekends, because preparedness doesn't stop. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We're glad to have this returning guest. Brien Lundin is a publisher of the Gold newsletter and the producer of the widely attended New Orleans Investment Conference. He joins us this Thursday, July 7th, 2022, ahead of the upcoming Rule Symposium on Natural Resource Investing. Brien, thanks for coming back on Liberty and Finance.
Great to be with you, Donegan.
We had you on a while ago talking about the New Orleans Investment Conference, whetting our audience's appetite for that. Now, later this month, in just 3 short weeks, we're going to be together live with you at the Rule Symposium on Natural Resource Investing in Boca Raton, Florida. Wanted to make sure that the key heart of the message that you think people need to hear about at this time, about what's really going on, that you get a chance to explain that to them, to our viewers. We have over 71,000 and growing subscribers, and they're eager for expert opinions of what direction we're heading. You've certainly done some analysis that would be useful for people in that regards, but also to give maybe a foretaste of what you think some of the main themes are that will likely emerge at the conference where we will both be attending. And so if we could kick it off, first of all, with the macro, the monetary and debt environment that we find ourselves in. People are just bewildered right now. It feels like we're on the cusp. It feels like we could just tip, lurching one way further into rapid inflation, or falling backwards on our face back in deflationary recession and depression. Some people say the greatest depression of all time. And similarly, the Fed seems to be on the cusp of what are they going to do? Are they going to do what Volcker did back in the 70s and raise rates to the sky to really quench inflation? Or are that going to blow up in their face if they even make serious steps in that direction because of the huge sovereign debt loads that are not only in the U.S. but globally? You've done some specific analysis into that, and I wonder if you could give us your insights that have emerged from the analysis that you did.
Yeah, absolutely, Donegan. You know, a lot of people are comparing today to the 1970s, and there are some easy comparisons to make some easy similarities. Primarily inflation right now. We've had a big spike in inflation. We had that in the 1970s. And importantly, we had that throughout the 1970s. We had peaks and valleys where the inflation rate would spike and it would come back to a still high level, then it would spike again and come back, et cetera. I think we're going to see something very similar play out in that regard. As far as inflation goes, we are going to see inflation come back from the levels that we've recently seen for a number of reasons, the year-over-year comparisons, et cetera. A lot of the kind of wonky data behind how the CPI is calculated is going to come back and bring back the inflation rates to not quite as high as they were over the last couple of months, but still relatively high, I think in the 5% range, 5 to 6% range. But one of the lessons from the 1970s is that we had these periodic pullbacks in the inflation rate, but then it would come back again as other factors kicked in. Wage inflation, which has not hit yet. A lot of services inflation still remains sticky. And then we've had a pullback just recently in commodities. And I'll get to that in a second. I think that's going to reassert itself and lead to a further spike down the road. But the important point that I like to make is that that's where the similarities with the 1970s ends, because to kill that inflation off in the 1970s, we had Paul Volcker come in with the determination to crater the U.S. economy if necessary to kill off inflation. And to do that, he raised the interest rates above the rate of inflation, which is the only way you can do it. You can kind of squelch those, the inflationary fire is basically you have to kill off economic activity and get interest rates above that rate of inflation. You can't do that today because back in the 1970s, Volcker had the luxury of doing that because the federal debt was 30% of GDP. Today, it's 130%. Really in banana republic territory, or what used to be considered banana republic territory. And because of that, you just can't raise rates that high. You can't raise it higher than the rate at which the dollar is being depreciated. In other words, the rate of inflation, because the cost of servicing the debt will absolutely explode. A lot of people are talking about the Fed being determined to raise the Fed funds rate to 5 or 6%. The futures markets are betting that they're going to get over 4% on the Fed funds rate. I've gone back and actually looked at the cost, the interest, the cost of servicing the debt, the actual governmental interest payments, and compared that to the actual size of the federal debt to get an effective interest rate on the federal debt. Then I've tracked that back over some 40 years. Over the last 20 years, that rate of interest, that effective interest rate on the federal debt, is usually about 2 to 4% above the Fed funds rate. So just looking at those numbers, if the Fed gets the Fed funds rate to 2%, which they likely will at the next meeting, then over an adjustment period, the interest costs on the federal debt will get to at least 4% of the federal debt. Now, with the federal debt owned by the public at about $25 trillion, that means that the debt service costs are going to soar to $1 trillion or higher. I think that's kind of a political brick wall that's going to stop the Fed, because people at that point will talk about actually defaulting on the debt. Seriously talk about that in Washington. Why are we paying this tremendous debt load of $1 trillion a year just going out to no one? And so I think that's going to be the limiting factor. Now, they could overshoot it. They could get to 3 or even 4% on the Fed funds rate, but that just makes things worse. At that point, we're talking a couple of $1 trillion every year on interest costs for the federal debt. And that's what people don't really appreciate is with the debt as large as it is now, even small increases in interest rates make a huge difference to the bottom line cost of servicing that debt. And right now, the Fed is not only increasing rates at a far greater pace than they did, say, post-2008. When they started raising rates in 2015, for example, they were doing it at the rate of a quarter point a year. Now they're doing 2 years' worth of rate hikes in a single meeting, and the debt is 3 times larger. So no one has really considered this, and that's kind of the gist of what I'm going to be presenting at Rick's Symposium later this month, is that the Fed is trapped, and they will have to start reversing that tightening policy much more quickly and much earlier than the markets are now really considering.
That double bind that the Fed finds themselves in is one that is not unique to the U.S. There are the Japanese central bank, others, European central bank, et cetera, are finding themselves in similar settings all around the world, and that may or may not be similar to the 1970s. You were drawing parallels and differences, but it's certainly a global phenomenon now worldwide. One of the observations you made along the way here is that this environment is basically a tipping point or a turning point, and that the Fed really doesn't have the ability to take the kind of effective action that would really result in quenching inflation, just because the magnitude of the impact on the deficit would be so egregious, and that just makes the problem worse. In your analysis, so you've pointed out that hard spot, between a rock and a hard spot we find ourselves in. What do you see as the most likely path out of that? And actually, what does that path look like? Because it doesn't sound like there's a solution that makes things better. It's like you can have this huge kind of pain, or you can have that huge kind of pain. What do you see as what you observe as being perhaps the most probable path, and what is the kind of pain we'll be observing on that path?
Yeah, there is no easy solution. And a lot of people will come out and predict what's ahead, whether it'll be a huge deflationary collapse and then an inflation, or just a deflationary collapse or a rampaging inflation. I don't think anybody can predict it, Dunnigan. I think there's just too many variables out there. I try to keep things simple. I know we're headed toward a situation that is dire with no easy solutions, that will eventually lead to the collapse of credibility of fiat currencies in general, not just the dollar. And that you're going to want to own gold and silver and commodities and things going into that. I think it's a trend that comes in cycles. And I think we're at the end of that trend that began, around 1980. We're towards the end of that, whether we have a couple more cycles, whether we have just one more cycle or three or even four before the fiat currencies lose all of their credibility. I don't know, but I think you need to own gold because it's going to go progressively higher over that period. And eventually currencies will have to be reattached in some portion in some way, in some fashion, to gold to restore that credibility.
You mentioned tangibles there, including commodities. Rick Rule has been talking to us for some time now about a bull market, and even the Aiden sisters, we've spoken with them from the Aiden Forecast, and others have been talking about this major bull market in commodities in general, including base metals, rare earth metals, gold and silver, foods, energy, all kinds of stuff. In that environment, we have seen so much of a beatdown of the markets in general over this first half of the year has been the worst year in 51 years for the equity markets, for example, that sort of thing, that a lot of people are wondering, well, where's this bull market everybody's talking about emerging? Rick has talked to us throughout the years about being a contrarian or being a victim, and I guess if you could address that topic of being a courageous contrarian at this, are we at a pit? Are we at a point which makes a reasonable entry point or a cost averaging and incremental entry point for people who really want to participate beneficially to their family in investing in real things, in commodities going forward? What's your view of that big picture for the commodities market and being a courageous contrarian?
Yeah, and of course, we all know that Rick is perhaps the best in history for buying at the bottoms and playing the cyclicality of the commodity markets to his best advantage. He has an innate sense of when the bottom has been reached. When Rick's buying, in other words, you need to be buying. When Rick's selling, you really need to consider selling. And so he's the best at doing that, and therefore the theme of his symposium this year really is the great commodities bull market. And I agree with that for a number of reasons. You have supply constraints that typically happen on a cyclical basis in the commodities markets. We have those, as we have had before, which are a feature and a result of many years of underinvestment in exploration and development. But now we have all of these commodities running up against one of the greatest demand growth curves that we've ever seen, particularly things like commodity, like copper, like all of the battery metals, et cetera. So there is a situation where a lot of commodities, really across the board, have to literally multiply in price to bring on new supplies. And you're ride that curve, and not just the commodities, but a lot of the associated investments in mining stocks and exploration and development companies. It is the time to be buying, and it is when blood is in the streets, as we know. And so the timing is just absolutely perfect for Rick's conference, which is coming again, or in addition, at a seasonal low for the markets. The end of July is historically right about within 2 weeks, where, say, the precious metals typically bottom in a year where that seasonality works. So it is perfectly timed, I believe, for contrarians, people who can look at the horizon, look at the bigger picture, and find and had the cash and the courage to act on these bottoms. Another great feature of Rick's events is that he presents a lot of, it's not just why and how, but specifically which investments. So he has a lot of the best companies out there presenting, and it's a great place to find the specific investments to take advantage of these cyclical bottoms.
I wanted to mention to our viewers as well that if they look in the description of this video, they'll find a link that allows them to register for the conference so that they can meet you in person, meet me in person, listen to these speakers, meet Rick, and so on. And they'll also be supporting our channel, Liberty and Finance, at the same time. If people want to make sure that they get plugged in with your analyses going forward at the Gold newsletter, where should they get connected with that?
Well, simply put, goldnewsletter.com or neworleansconference.com. You'll get all the information right there.
All right, Brien, looking forward to shaking your hand a few weeks from now and meeting all of our viewers who can make it there. I know that some have already replied in some of the live chats that we've had with our releases of our videos, which we do at 9 p.m. Eastern, 6 p.m. Pacific every single night of the week, that they plan on making it there. So looking forward to meeting as many people as can make it. And again, folks, look at the registration link in the description of this video and sign up for the conference. Brien, we'll see you there, and thanks for coming back on Liberty and Finance.
Great to be with you again, Donegan. Thanks so much.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Donegan, call 1-888-81-LIBERTY. That's 1-888-815-4237.